Right now, the stock market is making a multi-trillion-dollar bet. It's a bet that the incredible record-setting profits corporations are enjoying aren't just a temporary peak, but the new floor. These stock prices only make sense if you believe that this is the new normal forever. Today, the S&P 500's net profit margin is hovering near the highest levels seen in over a decade. But is this a brilliant insight into a permanently changed economy? Or are we living through a classic "this time is different" moment? The kind that historically has ended in a spectacular mess. This isn't just about being a bull or a bear. It's about understanding the high-stakes game you're a part of, whether you realize it or not. We're going to break down the two completely different stories the market is telling, explore the powerful arguments for why today's profits might actually last, and then face the historical warnings that suggest it's all just a grand illusion. To really get what's happening, you have to look at the market through two different lenses. And right now, those lenses are showing us two very, very different pictures. The first lens is the Shiller PE ratio, also called the CAPE ratio. Think of this as the market's long-term memory. It smooths out the ups and downs of the business cycle by measuring the current price of the S&P 500 against the average of the last 10 years of inflation-adjusted earnings. This gives us a clearer signal about long-term value. Right now, the Shiller PE is floating at levels in the low to mid-30s and has even exceeded 40 recently. To give you some context, that's higher than the level right before the 1929 crash and has only been seriously beaten by the peak of the dot-com bubble. Historically, a high CAPE ratio like this has been a pretty reliable sign of lower returns over the next decade. So this lens is flashing a bright red warning. The market is wildly expensive compared to its own history. But then you pick up the second lens, the forward PE ratio. This is the market's short-term eyesight. It looks at the S&P 500's price and divides it by what Wall Street expects companies to earn over the next 12 months. This metric is all about how durable people think current profits are. Today, the forward PE is somewhere around 19 to 21. Now, that's not exactly a bargain. The 10-year average is down in the high teens, but it's nowhere near the panic-inducing level the Shiller PE is screaming about. A forward PE in this range suggests that if companies actually hit their profit targets, today's prices, while a little rich, might be justified. And that is the multi-trillion-dollar contradiction. One metric, rooted in history, says we're priced for a fall. The other, focused on the immediate future, says we're priced for persistence. The gap between them isn't some statistical fluke, it is the bet. The market isn't just betting on growth, it's betting on the permanence of today's incredible profitability. Why this time might actually be different. So, what gives investors the guts to make a bet this bold against the history books? The bull case really stands on three powerful pillars of change. First, the S&P 500 just isn't the same collection of companies it was a few decades ago. The historical data that makes the Shiller PE look so scary was built on an economy of smokestacks and heavy machinery. Today's market is dominated by businesses built on intangibles, software, data, and intellectual property. We're talking about companies with recurring subscription revenue, powerful network effects, and the ability to scale globally with almost no extra cost. These business models can sustain much higher profit margins than the industrial giants of yesterday. The argument here is that the old historical average for profit margins just doesn't apply anymore because the game has fundamentally changed. Second, this isn't just a theory. You can see the strength in the numbers. In recent quarters, we've seen a high percentage of companies beating earnings estimates. For Q2 2026, the S&P 500 reported a blended net profit margin of 15.7%, which would be the highest since FactSet started tracking the data in 2009. When you see that forward PE of around 20, it's not propped up by fantasy. It's being supported by real, impressive earnings that analysts expect to continue, with forecasts for low to mid-teens growth for the index this year. Finally, there's the AI catalyst. And no, it's not just a buzzword. Short-term, AI is driving a massive investment cycle in chips, cloud infrastructure, and software, with spending projected to hit hundreds of billions annually and potentially trillions over the next decade. This is directly boosting the profits of some of the market's biggest players. But the long-term bull case is even bigger. If AI can actually boost productivity across the entire economy, it could structurally expand the total profit pool for everyone. This is the heart of the regime shift argument, that a technological revolution is rewriting the old rules of profitability. Of course, for every argument that this time is different, history offers a graveyard of investors who believe the same thing at the top of every other bubble. The skeptical case doesn't deny that today's profits are good. It argues that investors are dangerously overconfident that they'll last. The first, and most stubborn, argument against today's market is just the brutal math of high starting points. A Shiller PE in the mid-30s isn't a guarantee of a crash tomorrow, but it means the market is demanding a perfect future to justify today's prices. Think of it like buying a house at the absolute peak of a housing boom. To make a good return, you need rents to keep soaring, property values to never dip, and interest rates to stay low. A high CAPE ratio means the market has priced in that flawless scenario, leaving zero room for error, recession, or just plain bad luck. Second, there's a huge risk hidden in the market's structure. The S&P 500's incredible performance is unusually dependent on a small group of mega-cap companies, often called the Magnificent Seven. These few giants have such an outsized impact on the index's earnings that they can make the overall market look healthier and more resilient than the average company really is. This isn't a bet on the broad strength of the economy. It's a highly concentrated bet that a handful of dominant companies will stay dominant forever. If their growth slows or regulators step in, the whole market could feel the pain. Finally, we have to respect the iron law of mean reversion, especially with profit margins. Record high profits are like a beacon, attracting competition. They embolden workers to demand higher wages and attract the prying eyes of regulators who see excess profits as a problem to be solved. And that AI boom? It could be a double-edged sword. We see the massive spending on new infrastructure now, but the return on that investment is far from guaranteed. History is filled with transformative technologies, from railways to fiber optics, that required enormous upfront cash but took decades to actually generate sustainable profits for investors. Sukkri Orsas, CTA. So, with these two powerful but opposing cases laid out, where do you land? Are we in a genuine regime shift driven by technology that justifies these prices? Or are we seeing the classic signs of overconfidence, pricing in a perfect future that rarely, if ever, shows up? Let me know what you think in the comments. In the end, framing this as a simple bubble or not debate misses the point. The reality is that both sides have a point. The Shiller PE is giving a legitimate warning that based on history, long-term returns are likely to be lower from here. The forward PE is reflecting a rational belief that today's profits are unusually strong thanks to real changes in our economy. The S&P 500 isn't priced for normal growth. It's priced for a total regime shift. The bet is plausible, but the bar for success is incredibly high. It requires more than just a few good quarters from a handful of tech giants. So instead of a prediction, here's what to watch to see if this multi-trillion-dollar bet is paying off. The bullish case is winning if earnings growth starts to broaden out beyond the same few megacaps. It's winning if those record-high profit margins hold steady, even when the economy gets choppy. And it's definitely winning if the trillions being poured into AI start to translate into real, economy-wide productivity gains. On the flip side, you'll know the market is in trouble if growth gets even more concentrated in a few winners. You'll know the bet is failing if profit margins start to shrink under the weight of competition or regulation. And the biggest red flag of all will be if analysts' profit forecasts for 2027 and 2028 start to fall, even while prices stay sky high. The real question isn't whether today's profits are good. They're fantastic. The question is whether they're permanent. And that is a bet whose outcome is still very much in doubt.